We are here to discuss the mechanics of price. This is the core principle. Markets move because of liquidity and execution, not opinions. Everything that follows is a function of this reality. Execution begins with the order. It is the fundamental footprint in any market. Every participant faces a choice. A market order prioritizes urgency. You need execution now. Price is secondary. A limit order prioritizes price control. You dictate the price, but execution is not guaranteed. The order choice defines execution quality, not directional bias. So, who is forced to trade with urgency? It's typically not a discretionary actor. It's an institution executing a mandate, a portfolio rebalance, or it's a risk system triggering a stop. These are not opinions. They are mechanical actions. Their need for liquidity is absolute. Institutions are constrained by their own size. A large order, if shown, creates adverse price movement. Their objective is not direction, it is impact mitigation. They use tools like iceberg orders to mask their true size, showing only a fraction of the total order. This is a defensive tactic to manage execution costs. All participants, regardless of size, face a non-negotiable cost. The first cost of execution is the spread. The spread is the difference between the best bid and the best ask. This is a direct transaction cost. When you demand liquidity with a market order, you pay this cost. The liquidity provider, the market maker, earns it. The spread is dynamic. When spreads widen, information risk is rising. Liquidity providers increase the spread to compensate for uncertainty, to protect themselves against informed order flow. For anyone forced to transact in this environment, the cost of execution rises significantly. The spread is an explicit cost, but there are also implicit costs created by your own order flow. These are impact and slippage. An order for 500 shares is absorbed. There is no impact. Now, in order for 500,000 shares, this is different. It consumes liquidity across multiple price levels. The act of execution itself moves the price adversely. This price movement is market impact. It is a cost created by size. This is a key principle. The market reacts to size before it reacts to news. A large order is a mechanical imbalance that requires immediate resolution. News is a narrative that requires interpretation and time. This leads to slippage. Slippage is the difference between the expected execution price and the actual execution price. It is the reality of transacting in a dynamic market, a function of available liquidity at the moment of execution. Slippage is not random. It is caused by market orders during volatility, by thin liquidity, and critically by stop orders during fast moves. Stops are a critical mechanism. They convert uncertainty into forced liquidity demand. A stop order is passive until triggered. Once triggered, it becomes a market order. In a fast market, one triggered stop can create a cascade, pushing price into the next level of stops. This creates a feedback loop of forced price-insensitive selling that amplifies volatility. The spread, impact, and slippage are all symptoms. The underlying driver is liquidity. The liquidity environment dictates execution quality. High liquidity means tight spreads, deep order books, and low impact. Costs are minimal. Low liquidity means wide spreads, price gaps, and violent moves. In this environment, execution costs are high and unpredictable. Price moves because liquidity disappears, not because of opinions. When liquidity providers withdraw, the market becomes fragile. A small imbalance can then create a disproportionate price move because there is no order flow to absorb it. Given the fragility of the continuous market, how do institutions trade size? They use a different structure. The auction. Continuous trading is fragmented. Liquidity is dispersed. An auction concentrates liquidity into a single point in time. It finds one price to clear the maximum volume. This is why institutions rely on auctions for benchmark execution. The open and close auctions are significant because they compress information into a single benchmark price. An institution can execute large size at one price with minimal impact against other large participants. It is a mechanism for trading size. To summarize, 1. Markets move through order flow, not indicators. 2. Execution cost is a sum of the spread, slippage, and impact. 3. Liquidity is more important than direction. 4. Auctions are for size. 5. The continuous market is inherently noisy and fragile.
If you don't understand how orders move prices, you're trading outcomes without understanding causes.